But here, one important aspect I want to point out is RedStone is the only oracle that has never ever had a single price manipulation or downtime event.
Hey everyone, welcome to the Level Up Podcast, presented by the Medici Network, the exclusive community for financial institutions to engage with blockchain-native funds and founders. I'm your host, David Breiter.
And I'm your host, Sean Farrell. Before we kick things off, make sure to hit the subscribe button and follow us on Twitter for the latest episodes.
This podcast is for informational purposes only, and nothing herein should be considered financial, legal, tax, or investment advice. The views expressed by our hosts and guests are their own and do not reflect those of the Medici Network, Fundstrat Global Advisors LLC, Finality CP Management LLC, or their respective affiliates. All listeners should consult their own professional advisors as to the legal, tax, financial, or other matters before making any investment decision.
Now, let's get into it.
Hey everyone, welcome back to Level Up. David and I are excited to be speaking with Marcin Kaźmierczak, co-founder of RedStone Finance. They are a modular oracle. They compete with the likes of, Link and Pyth. David, why don't you give us the rundown of their token summary?
Yeah, Sean. So RedStone, ticker RED, and price is about 30 cents. And it's one of the smaller names we've had on the show. It's a small cap. It's about almost 100 million market cap. And, I think that sometimes it is useful to have be open to, looking at smaller names. I think you can learn a lot about, at a minimum, the industry, and maybe every once in a while you find an uncovered gem. And, here, as Sean mentioned, they're a competitor to Chainlink, Pyth, and some other oracles. And, what is an oracle? It's kind of an interesting name. Crypto, we love our terminology, but I think one way to think about an oracle is it's just it's a solution for putting data on chain. And one analogy that I like is that a blockchain is kind of like a computer that's not connected to the internet. It knows everything that's happened on that computer, but you have to upload outside information to it to get that, for it to know you, to connect to the web, to know what's happening outside events. And oracles are really that bridge, that gateway for uploading outside information, either from the real world, from other blockchains themselves. And many of the Web3 oracles try to say, in the spirit of decentralization and potentially, for robustness of data, let's try to do this in a way that is decentralized as opposed to one single source doing that. And, an oracle like RedStone, Chainlink, and others, they will take that off-chain data, whether it's price feeds, et cetera, feed it through to, several, different operators who have are considered oracles or nodes in the network. And they can aggregate those prices, and they can put them on chain and be used by smart contracts and different applications and users as well.
Yeah, that's right. And like I mentioned, I dropped the Link and Pyth tokens earlier. Those are the native tokens of Chainlink and Pyth, two competitors in the oracle space. Here you have a breakdown of blockchain oracles ranked by TVS, or total value secured. And you can think of this simply as, the aggregate value of all assets that are relying on these data feeds produced by oracles. And, so you can see here that clearly Chainlink has majority market share with, 68% TVS. I think it looks like Chronicle's in second place and RedStone is in third with 6% market share. Now you could debate how, the efficacy of this metric in terms of what this means for value accrual to the actual underlying protocol and the token itself. But I think it does, give folks a good sense for distribution and, how reliable dApps generally view these different protocols. And here is another way to compare these oracles. Here you have a comparison of RedStone, Chainlink, and Pyth. I think there are a couple things to highlight here. One, RedStone has a push and pull model, whereas Chainlink is just push, Pyth is just pull. The the Eli 5 and for push and pull models. Pull is is upon request. Push is a constant feed of data at an interval, and RedStone has the capability to service dApps with both methods of distribution. And another thing to highlight is that they also are able to support a number of non-EVM chains. Pyth has this capability as well. Chainlink does, but not to the extent RedStone does. And also from a price feed source, they have RedStone. I should note that this comparison table does come from RedStone itself. But they list CEXs, DEXs, aggregators, and institutions as price feed sources, whereas Chainlink they really just take their price feeds from aggregators, and Pyth is sort of a different model altogether.
Yeah, I'd be curious if Pyth and Chainlink would agree with the characterization of these this table, but it's always good to get perspectives from each of the projects for what they see. RedStone obviously being one of the the smaller player, maybe the more hungry, nimble one, and that's really allowed them to kind of go across multiple chains. And they might be small, but they're trying to be mighty, and they've gone to get some traction in the tokenized fund space and other areas. And Sean, what is this here with the architecture?
Yeah, so this is RedStone's layout of their architecture. And I'm sure Marcin will talk about this to a more detailed extent. But essentially, they take all of the pieces of a Oracle network and break them apart into different modules. And this modular architecture, this is what allows them to deploy and scale on different networks more seamlessly.
Talking about the business model a little bit, I mean, great. What do you do with all this data? Well, I think at the end of the day, once you get that data onto the chains, it gets used by end consumers. And who are the end consumers of oracles? Really, I think it's like chains themselves. Whether you're a new blockchain and you want to have the data feeds for, applications to use on your chain, you might pay for an integration, whether it's you're an actual dApp or a decentralized application, a borrowed lending protocol, you might pay for that data, maybe for liquidations, or perhaps you're an institution looking to utilize price data or some other data happening. You might want to buy that data from them as well.
Yeah, that's right. And like you said, ultimately what an Oracle is trying to provide is just a high fidelity price feed. And here you have a screen capture from RedStone's website in which they feature all of their different data feeds, and you can see that they track 1,400 assets, Bitcoin, ETH obviously being the top two, but they have price feeds for a number of assets, wrapped assets as well. And like you mentioned earlier, they also have carved out a niche in the RWA tokenized RWA space.
Yeah, and obviously oracles can do more than price feeds, but this really is the main source of business for most oracles. And when you put that price on chain, you need I guess a couple ways to have some security over that. And one way is you kind of get it from several sources, and hopefully across those you think someone's being honest. But a newer approach that's maybe gets more explored in the future is using restaking. And for those not familiar, this is built on top of EigenLayer. RedStone is what's called an actively validated service, an AVS built on top of EigenLayer, where essentially collateral gets posted or restaked to secure, or in the future, hopefully secure, the integrity of the data feeds. And, I think it's a nice idea and concept. I'd like to see this become more prevalent.
Yeah, so just to unpack that, David, real quick. So what you're saying is, to protect data integrity, the fidelity of that data, you'll have nodes, these data providers stake tokens, and if they, provide bad data, the other participants in the network can slash their economic stake.
Yeah, I think it's like legal recourse, right? If that's right. If you had if you lied on an application and you had bad data, maybe you can sue or you can have recourse, and that's kind of what restaking aims to provide. There's 140 million staked with RedStone today on Eigen. Now, I think the thing is, though, I have a question about really, I'm not sure that, there might be staked. I'm not sure that there's actual slashing implemented here. I'm not sure that the security is actually working in practice. These things might take a little time to work out, but it hasn't really stopped RedStone getting clients. This is from them. The RedStone, as according to them, they have about over 100 dApps, over 70 chains, and over 30 asset issuers. And again, here's kind of the growth of the total value secured. Debatable what that means for the token value.
Like we mentioned, there is right now staking of Red for those data providers, those nodes on the network, and I think as of now, like you had alluded to, most of the payouts to these stakers is really through issuance, and I'm not sure that there's actual fees being remitted to these nodes, to these stakers rather. And so I think, it'll be interesting to get some input from Marcin on whether that's something that's on the roadmap, something that could perhaps, obviously there's some semblance of demand if there is, staking involved, but would certainly help to bolster the, value accrual mechanism of the token if there was some kind of fee remittance involved as well.
Yeah, that's right. I've always kind of been of the view that oracles are a good business, but I'm not sure that, this applies to Chainlink as well. Obviously, I think Chainlink's a great business and they collect a lot of fees from integrations to the, at least to the labs entity, is what I've heard over the years. And but I'm not quite sure for oracles in general as a category, how much of that really is flowing back to token holders and, underpinning the value of the token. And this is just a look at the distribution of the token since its launch, and as well as the unlock schedule. RedStone being, an Oracle net, or being an Oracle business that's been around a while and a more recent token. Being a small cap, I guess you could put them in the kind of low float, low FTV category. But it does look like their supply will be increasing a bit over the coming years.
Yeah, and here's the comp set. This is the Oracle space. You can see that, Red certainly the ticker is Red. Has not performed remarkably well this year, but has not necessarily underperformed its peers, as the broader Oracle space has not done all that great. And I think we've been alluding to this, but I think some of those dynamics around lack of value accrual for the token, I think those might be what are plaguing these tokens more broadly. And here you have some metrics for these comps. As we noted, there's not really much to sink our teeth into here. We'd like to see some revenue metrics or fees, but there's a lot of opacity around those metrics. But if we look to the one metric that is readily available, that is total value secured, I think you can make the case that, RedStone relative to its market share, I think is trading at, a discount to its peers.
Yeah, and I think really the key will be, can the fundamentals kind of support an uptick, and, that could mean something for the chart and for the price. And, we don't want to rely too heavily on any technical trends, but we just, like to give it a last and final look and see how it could play in with the story and the fundamentals. And, I just think the only takeaway really for me on the red chart is just that it's been in quite a meaningful downtrend since, really September. And it's kind of at the bottom of this support range it made back in, I guess that would be June or July. And, let's dive into the show. I'd like to hear, what, fundamental metrics and adoption are on the roadmap, and see if, what could possibly be in store for RedStone either now or down the road to get this turned around.
Yeah. Maybe we have a nice turnaround story on our hands. Let's get into it.
All right, let's get into it.
Well, with that, we would like to welcome in Marcin Kaźmierczak, co-founder and COO of RedStone Finance. Marcin, how are you doing? Thanks for joining us today.
Hi, everyone. It's a pleasure to join. Thanks for having me.
Yeah, maybe to start, we give the audience a bit of information about your background and some context behind what led you to build RedStone and broadly what you're building.
Yeah, happy to start. So I'm one of the co-founders of RedStone, responsible for everything related to go-to-market. So BD, marketing, going to conferences, sweeping the floor if that's needed. I started in crypto in 2017, writing my bachelor thesis about Ethereum, Bitcoin, early days. At that time, I was a student at Warsaw School of Economics in quantitative methods. So I was fascinated by the concept of creating monetary policies with crypto coins in general. Those are fun times of EOS, IOTA, and other interesting animals of the early days. Then in 2020, I worked at Google Cloud, expanding programs related to adoption of the GCP products. An old-time friend, Jacob, who's the technical founder of RedStone, asked if I would like to join him on a journey of creating a new Oracle that's going to be scalable. And I had very little hesitation. Jacob is at that time was one of the most respected smart contract auditor in Europe, early days in Open Zeppelin, and has been in Ethereum since 2015. And he spotted that Chainlink, even though was covering a lot of useful use cases in DeFi in the early days, was hitting scalability issues. And that's how RedStone came into existence, with the primary goal of making sure that we can support builders holistically without hitting the ceiling of scalability of the heavy monolithic push model as Chainlink has been creating. And now in 2025, it's going pretty well.
That's a really great introduction. Maybe, for the listeners, could you just give us like the high level, what is the actual investment thesis behind, obviously RedStone, the network, the product, the Oracle, but also the Red token?
Probably start with the categories, oracles. I would say that people could agree that data is the new oil. In any industry, data is something necessary to create high fidelity of the products and solutions. And oracles is this solution, the product that helps to connect the outside data with the blockchains and applications. And that's where Chainlink came into place in 2019, 2020. However, right now with hundreds of blockchains, thousands of applications, and unlimitless number of tokens and tokenized assets, the ecosystem needs a solution that is scalable and can adjust to the needs of the developers as they build. So the thesis for oracles is that if you believe that data rules the programmability on chain and you need more than just smart contracts based on the information that is living natively on blockchains, then you believe in oracles for the connectivity. And then you believe in RedStone if you trust that the space is going to still explode and the number of builders and clients is going to come into the market, including also the institutions, and a nimble, highly adaptable player is needed over there with technical excellence, because this is something that is in DNA of RedStone. And as for the Red token itself, the primary utility is the staking mechanism. So holders can stake on the data providers that deliver data into the network. And with time, we will be distributing parts of the revenue that the ecosystem generates to the stakers themselves. Right now, they earn rewards in the Red token, but with time, it's going to be gradually smoothen out with the revenue itself.
So you mentioned push and pull a couple of times, and how, I'm reading between the lines, RedStone offers, solutions for both the push and pull model. Chainlink perhaps only offers solutions for one of those models. Can you further unpack that and the differences between the two? And is that the core differentiator between yourself and Chainlink?
I would say the core differentiator is in the principles of creating the product. So Chainlink was created in 2018 in very monolithical architecture because back then only Ethereum mattered. And maybe like they believed there would be 2 or 3 blockchains. Whereas RedStone, when we started in 2020 and 2021, Jacob as an engineer knew that we have to create a modular structure that has specific parts that can be updated based on the best technology available, because the innovation cycle in crypto is probably 3-6 months. So you need to keep updating your product, not to allow it to be legacy. And every part of what we deliver is highly customizable based on the needs of the customer. That's the reason we are still the only one delivering proof of reserve for Bitcoin staking, liquid staking, Lombard, for example, LBDC. We deliver price feeds for RWA assets, have high frequency solution for networks such as MegaETH or Monad. So I would say it's the principle of development that distincts us from Chainlink the most. In terms of the push and pull right now, I believe Chainlink also has solutions on both sides, though the pull one is fairly suboptimal and not widely adopted, but it is present. For us, the most important is listening to the clients and delivering quickly. So what speaks volumes is the testimonials and opinions that true builders have in the market about RedStone speed and accuracy whenever we deliver a solution. And it's pretty the opposite nowadays when it comes to Chainlink development, which is many times associated with quarters of timeline, with very high price tag and very little flexibility in terms of what you can ask for specific use case that you have. On our website, we have like a comparison between us, RedStone, and Chainlink on the blog post. And it's a table that fairly well compares the 3 major oracles on the market. So if anyone would be interested to check out like the specific aspects in terms of, for example, the mispricing incidents, which in our view is the most important metric for an oracle to measure, not speed, not how many blockchains you deliver, not how much narrative you create, but the actual reliability, because oracles is for resilience purposes mainly used by the builders, because anyone can create an oracle, right? And then the question is whether you can deliver what is needed and with the resilience that your protocol require. And then a couple of other verticals out there.
How do you think about it relative to some of the other oracles like Chainlink? Like you talked about Chainlink, but like Pyth, and then also like how does I don't know if you've looked at like zk-TLS and some of those solutions. I kind of think about those like the oracles can cover public data pretty well, and then like the zk-TLS is do private data. I want to put my bank account and put on chain that data. How do you think about some of those dynamics?
So we keep track of the ZK technology very closely. Look, maybe taking a step back, RedStone is a team of developers, of builders. Like our motto is by builders for builders. And we mean it when we say it. 60% or even more of our team is technical people. So engineers, product managers, and so on. That's the reason we can deliver at a very high speed of the product development cycle. And speaking about zk-TLS, we've been observing ZK for the past, 3 years already. And over, the issue seems to be still the same, which is the time and the cost of generating those proofs, and then the customizability of what you can deliver with them. So as you mentioned, in a area where privacy is extremely important, naturally they have the use case, and we cooperate with partners that can support us in creating such use cases. For example, EigenLayer is a company that is very close to us. And whenever we have a request for ZK solution, we plug in those partners. But we are a company that is extremely pragmatic and is run by what is truly needed on the market. So we wouldn't be probably the first to go on the market and say, hey, this is this huge ambitious thesis. There is 1% probability it's going to happen, but if we do it, we are going to absolutely hit the jackpot. We are way more driven by what people talk about and would need to go further. So I would rather call it, we create products and solutions that have 80, 90% chances of being useful and delivering like actual value for the clients. And then measuring the impact by how much revenue we generate, how many users there are, how much interest there is for the upsell or further implementations. And a good example for that is the push model that initially we delivered for the dApps, because the dApps were not familiar with the pull model. They said it's not so easy to integrate. So they asked for the push one. So we delivered to them and they started paying us. And then it turned out that actually for the asset issuers, that's the biggest unblocker. Because if you're a protocol that issue a new token, for example, Youth Bank stablecoin, or back in 2023, LSTs, back in 24, LRTs, and we are going to see more and more assets, then you need an oracle to integrate that asset into DeFi. And the cycle for creating the price from Chainlink is super long. And in crypto and in DeFi, you cannot wait. So that was like an example of a product that we deliver because people asked us for. And then we doubled down. And right now, creating a new price feed can take us a day if it's truly necessary.
Can we stick with the products? So what are the main products, and then who are the customers, and then how do those integration processes work? You mentioned how Chainlink's integration process works, and how does that work typically for oracles?
Yeah, so I would say we have a very healthy product suite right now, especially with a recent acquisition of Credora, where we offer risk ratings, and a new product with historical data that we are going to launch in December/January. But talking about the current product suite, we have to identify four major types of clients. The first one are dApps, so Morpho, Compound, Spark, and so on. So applications that consume the data. The second category are asset issuers. So Etina, EtherFi, Lombard, Lido. Someone who has an asset that is used in DeFi needs an oracle to integrate that asset into those dApps. And then the third one are chains. So usually new or existing ecosystem that want to attract both dApps and asset issuers. So it's a kind of like a cycle with all of them. And then the fourth category I mentioned are institutions that look at those three and figure out like how necessarily they can plug into that via tokenized assets or maybe some implementation for their retail clients and so on and so forth. In those three categories, we have push and the pull oracles as the major products, like high level. And then the push model can be divided into a couple of subcategories. One of them is proof of reserves. So for example, we gather reserves of an asset all together and deliver on-chain the backing. I was talking about Lombard, so let's use it as an example. We index all Bitcoins that Lombard has in custody as a backing. And then we gather information about all LBDC that are minted across all the blockchains that they are natively mintable. And we divide the two values. So we showcase that for every one LBDC, people will be able to redeem BDC. Should there be a hack on, for example, Lombard, and they lose, in example, 20% of the custody, our methodology is going to price LBDC at 0.8 against Bitcoin, right? Because right now there is 20% shortage in the amount that you can redeem. Second category are fast delivery price feeds, which is RedStone Bolt, is a product that we developed specifically for MegaETH. So when MegaETH was launching their testnet, they were looking for a provider that can match their speed of block time production. And we were chatting a bunch. Now I can show you a screen of the live implementation on testnet that's going to be live on mainnet. So RedStone Bolt is an oracle, push one, that delivers price feeds on chain up to 2.4 millisecond frequency. which means that every second we can shoot more than 400 updates. For a regular brain, it's pretty hard to comprehend like this magnitude of updates that are present over here. But if you want to push the infrastructure to the boundaries of the internet, collocation, how quickly you can literally fetch the data from a source and then deliver it to other place that is collocated in the same place, it's the ultimate solution, right? So in TradFi, there was this book, Flash Boys, that was talking about similar dynamics that were happening on the Wall Street like years ago. So right now, I believe Mega Eve is hitting a similar team over here, and we are here as engineers to ensure that the pipeline that we create is meeting that speed. And Bolt is going to be also live on Monad itself. And then for institutions, when they have tokenized assets, when you have RWA, not many people think about it, but when you have an asset that you tokenize on chain, may it be treasury bill, may it be private credit, reinsurance, or any other financial product, then the value of that asset is changing in time. For T-bill, it's usually like only up, but for private credit, it can have a decline when some of the loans are defaulting. And all that information about the price and any other important data is delivered by an oracle to the protocols on chain. So this is literally what we are doing for an example, Securitize, Spyco, Midas, and a couple of other tokenization players. So those would be the major product suites. We have also Atom that is for intelligent liquidations and minimizing OEV, Oracle Extractable Value, and a couple of other smaller products, but those would be the main categories.
Probably should have prefaced the past 5-10 minutes with this, ostensibly pretty simple question, but maybe we should actually step back and define push versus pull. I'm reading between the lines. I assume that, in a non-technical, I think the non-technical way, simple way to look at push is that data is always on chain and available. Pull is the opposite. It's only delivered when requested. Is that correct? Is that the right way to interpret that?
Sort of. So in pull, you always have the data off chain that is constantly updated within the Web2 system. And then most likely anyone can pick up that data and deliver it on chain. Whereas push is, for example, taking that data and creating a service that delivers that on chain with predefined parameters, usually deviation threshold. So the difference between the last update and the fresh price that is available off chain, or time.
It seems to me that push would be superior for anyone that wanted to have, a proper, accurate price feed all the time. Why is that not just default?
So in order to push data on chain, you need to pay gas. So RedStone Bolt, in my opinion, RedStone Bolt is the ultimate oracle because you have the push oracle. So you always have the data available on chain on every block of Mega Eve. And then the reason we can do that is because Mega Eve allowed us to take care of the gas. So we don't have to worry about that part, right? And the reason for that is because they chose us as a specific partner. You probably cannot subsidize couple oracles doing that, right? Because you're going to spam the network. But if you choose like a very close partner that you're going to allow to deliver that many updates, then it just economically makes sense. On Ethereum mainnet, if you wanted to deliver, for example, every even 10 seconds a price feed, you would spend a lot on gas. And it's not even the problem of now. It is the problem of high volatility, because when the high volatility hits Ethereum, then you can pay even up to $1,000 for a single transaction, and an oracle has to update. Otherwise, on chain, you have stale data and a hack can occur, right? So this is this dilemma of optimization of cost versus accuracy versus being comfortable for the developers to integrate the solution that you deliver.
Push data is being subsidized by your protocol partners. Is that correct?
Whenever we deliver push oracle for a new asset, we have a contract with the issuer that covers like the cost part for us, like the revenue, but also commits to covering the gas cost. So if it's on an L2, like Arbitrum or ZK Sync or wherever, that's usually negligible. Let's call it $20 a month. So nothing special. But on Ethereum mainnet, if you want to have aggressive, so fairly frequent updates, It can be sometimes $1,000, $5,000, really depending on the asset and how much volatility there was during a specific month.
So that is revenue coming in the door for you guys?
No, so that gas is spent on the update. So it goes to validators on the network towards which we throw the data. So if we throw it on Avalanche, the validators get it. The revenue we get is a separate story. So those are like two separate components. Usually when you request a price sheet from RedStone, there are three components. One is the setup cost. The second one is the maintenance. And the third one is this gas. And this gas is the most variable. And this is something that we don't take on us. Like we could technically create a package that maintenance and gas is within one price, but then we would take the risk of gas spiking and us paying for that. Therefore, we give it to the client and we ask for a higher prepayment whenever we create a new price feed.
Can you unpack the revenue model, how these, I know you just broadly covered how these customers are charged, but maybe talk through, pricing relative to data throughput. Just how the revenue model works in a more detailed fashion.
And I'll add one thing. If you could just kind of also contrast what goes to the network, for the red token, if any, versus maybe a labs or someone that helps set it up. And I'm also curious how it works for other oracles like Chainlink, if you know.
Okay, so let me start with oracles as category, right? Because we should probably look at every player that is within that bucket. So what's the revenue of Chainlink right now? I don't know. And I believe not many people know exactly what's the sum of it. I know some people try to do those Dune dashboards or analysis of chain, like how it exactly works, but they many times mix the thing that I explained. So what is paid to the node operators? This is a cost actually, not a revenue for Chainlink, right? Like they have to pay those operators to deliver the data. Or for example, what is paid for a gas to maintain the price feed. And again, this is a cost for Chainlink to pay and ensure the data lands onto the blockchain. So what is the revenue for them or Pyth? I don't know. And to my knowledge, it's also not necessarily public. In terms of how RedStone generates revenue, we take it from those four types of customers I mentioned. So whenever there's a blockchain that would like to have data for the dApps and asset issuers to be present to essentially bootstrap DeFi activity, because without oracles, I believe the only DeFi primitive you can have is regular DEX. You cannot even have a perp DEX that is going to work efficiently. So if you want to have lending, CDP, vaults, and so on, usually the oracle is necessary. So when you have a new blockchain, and we can talk, for example, Monad that is launching in Q4, you need an oracle. And such a blockchain would pay us the setup and then maintenance fee for supporting the oracles that we deliver over there. Usually it's anything between 1 to 5 year contract, with the average being 2 to 3 years. 1 year is usually too short for those kind of players. 5 years is a very long time in crypto, as you can imagine. Then the second type of clients are those asset issuers. So again, EtherFi, Ethena, Lombard, and so on. Those clients pay setup fee and then maintenance on every network that we deliver the price feed for. So at the very beginning, let's get an example of EtherFi. They launched on Ethereum mainnet. So they had only one price feed on Ethereum mainnet in the push model. And whenever we do a push model, pool is available always, right? Because it's off chain. Then EtherFi wanted to expand to Arbitrum, ZK Sync, Optimism, Base, and so on. So for them to be active in DeFi and allow looping strategies, mainly with LRTs, they required an oracle to be present over there. So we added a setup for those networks and monthly or quarterly maintenance for each of them. So this is the second component. Last but not least, we have the dApps, the protocols. So whenever a dApp wants to use an oracle from RedStone, sometimes it can use it for free. And sometimes we have a specific contract with them when we deliver the dedicated price that they require. And in order to support the revenue on the dApps protocols, we also created RedStone Atom, which is a product for intelligent liquidations. And here I can explain how it works. So as I mentioned, in the push Oracle model, you can have updates that are defined by deviation threshold. So you can imagine a situation where an Oracle has not updated the data on chain yet. So the last update is $1,000 and $1,003. Liquidation is at $1,000, but the deviation threshold is going to hit at 997. So there is this short lag between the previous update and the next update and the liquidation. And that creates inefficiency and also potential for bad debt for a protocol. And even more so, when an Oracle update hits chain, all the liquidators see that and know the liquidation opportunity is a profitable one. So they would try to sort of bribe the block builders to include their liquidation as the first one. So effectively, there's an efficiency because they pay the block builders in order to be the one to liquidate. Now, we created a new product called Atom that is integrated, for example, in Compound, in Venus, in Felix, in, I believe, Hyperland right now as well. And it's expanding now on Sei network and other blockchains that allows for an auction for a liquidation price feed. So you can imagine that in this pool Oracle, the Web2 component, the price feeds are always updated and available. And at a certain point, you cross the liquidation threshold off chain and you would deliver the price on chain. Before the delivery on chain, together with our partner Fastlane, we create a flash auction that lasts only 300 milliseconds, so 0.3 second, that allows liquidators to bid for the priority pass to liquidate with that price. So you can imagine the first liquidator says $5, the other one says 10, and then we gather the best bids and we create an ordered list of liquidators that have the priority pass to liquidate. And then the price update on chain goes together with that list and liquidates at that very moment on chain. So it means that first liquidator has the opportunity to liquidate. If for whatever reason it misses, then the second liquidation goes and the third liquidator and so on and so forth. Why we create such a system? Well, because now we have a new revenue stream that before was going to block builders, and now it goes to us, essentially, for allowing the liquidator to get this priority pass that we can redistribute back to the protocol in a form, for example, for lend or borrow incentive. And part of that revenue is also going to RedStone itself. So it's a neat model where you redistribute the value, again, from the block builders to the Oracle and the protocol itself. And then the fourth category of the clients, we have these institutions, and those are very bespoke and customizable deals. Right now, majority of the times, it's that the institution has a tokenized asset and requires the price feed to be live on chain, as it is, again, with Securitize or Spyco. And then those contracts are usually yearly with a maintenance and delivery.
I've always thought like Chainlink has a good business, but back to the kind of point earlier, right? I think they probably make a lot of money for labs and the integration fees and all the stuff that's paid. But like, I don't really like you said, you don't really like most of that doesn't make its way on chain. No one really knows. So back to your four examples, like when you say the money goes to RedStone, which components go to the RedStone, to the Red token, like to the Red token protocol versus RedStone kind of an operating entity?
That's a very fair question. So as you heard, majority of those contracts are usually held off-chain because the counterparties that we interact with are institutional or regular companies players. So whenever we do it with a blockchain, then they could pay us in crypto. But many of those are executed in fiat currency, not because even we prefer that. We can accept any sort of payment, but because the other party prefers it for accounting or any other operational purposes. So as it is for today, the stakers of Red tokens receive the rewards in red tokens, but also in Eigen tokens, because the whole staking infrastructure is based on EigenLayer, and they allowed bonus rewards for the top 3 AVSs, and RedStone is one of them. But as we progress, we want to stream parts of that revenue to the token holders. However, I will be frank, RedStone launched the token in March of this year, and is a fairly, I would say, still fresh company. So we focus on the growth, on growing the revenue, ensuring new clients are onboarded, and making sure that the products that we launch, the new ones, are sticky and are generating enough revenue to, in the future, ensure that it goes to the stakers themselves. I'm personally not a big believer of launching a token and then 1 month later buybacking and then distributing the revenue super quickly. I believe the model of Uber or many other like startup companies that invested a lot in, even Amazon for many, many years, reinvested for the growth, and then eventually started to stream the revenue to the token holders, shareholders, makes more sense.
Can you give us a sense for how much revenue that, centralized entity is doing today?
I'm not sure if I'm allowed to share that information, like it's not a public one, similarly as it is for Chainlink or Pyth. One thing I can ensure is that we treat RedStone as a business. And in my view, to create a business, you need to look at the cost and the revenue side. And we are very prudent when it comes to the cost side. So we keep our team fairly lean for what we deliver, ensure that no one is overpaid in the sense that the salaries are kept at the market level, not like some companies just would go for the CMO for $400,000. And I saw many of such stories on Twitter and around. And last year we closed at break even. So this year we keep growing our revenue, but we also grow our spend. I cannot say like the exact numbers, but this is where we are oscillating.
Can I ask maybe a question a different way? And I know you're not going to know the answer precisely, but if you had to ballpark it, how much revenue do you think goes to just oracles as a category? Chainlink, Pyth, you guys, like, the labs entities or the networks as a whole every year?
I don't know. It's very hard to estimate. I would probably assume more than to, for example, bridging. I do believe bridging is even harder business in the sense that everyone is undercutting each other. With oracles, there is, in my view at least, a bit more differentiator between the products, the offering, and how you structure those kind of deals. Like there are quite a lot of variables in which you can use, like levers. But I cannot say like the exact number for oracles as a category.
How should investors think about the market opportunity and the size of the market? Because as you noted, there is, with not just you guys, with Chainlink and Pyth, there is a lot of opacity around, those revenue line items and how much is actually, relative to how much is actually coming on chain.
That's a fair question. I think at that point, it's the most important to look at the ratio of deliverables. So basically like growing the market in terms of the number of clients, the distribution and penetration versus the potential cost. Like cost is also not known for everyone, but roughly the size that I know of, Chainlink is 700 people company with large infrastructure, operational cost and gas and whatsoever. Pyth, to my knowledge, is about 65 people. And RedStone right now is 45, 50. And majority of our team members are also engineers focused on the product side. So I believe at that stage, it's still the moment that they just have to look at the soundness of the business from the fundamentals perspective, and then looking at the opportunity in the future. One thing that I can say over here for sure is that institutions paying oracles is not a meme anymore. Because it used to be in 2022 and 2023. I have quite a high confidence and market information. The majority of the announcements with institutions were purely for PR reasons or like creating a brand. Whereas right now institutions are very ready to pay for Oracle services depending on what they need. And those kind of contracts are usually larger and more serious. In example, when we were creating a cooperation with Securitize, the amount of due diligence we got from their partners like BlackRock or Hamilton Lane was pretty heavy, but thankfully we did pass it. And I see a big opportunity in those institutional deals going forward as well.
Appreciating the fact that, we don't have a view into those top line numbers right now. What other KPIs should investors be focused on right now? And can you take us through where those numbers stand?
Happy to. One of them is number of serious clients. So I'm not talking about hackathon projects that have just a logo and 0 users and you can account it on your website as a client. I'm talking about protocols that generate some sort of like revenue and are able to pay you. And this is something that we track regularly on our clients page. Second is total value secured, which is a metric of cumulative total value locked in protocols that are consuming the data from oracles that is at risk if that oracle blows up. To give you a specific example, if tomorrow RedStone blows up, around $10 billion would be at risk because our TVS currently oscillates between $8 to $12 billion. As you know, majority of the assets that we protect are cryptocurrencies. So depending on the day, it fluctuates quite a lot. But then you also have stablecoins, RWA, and other these types of assets. As far as I remember, right now, Pyth is at around 8 billion or 7 billion, and Chainlink is quite ahead with 75, roughly. Then the third one would be number of chains supported. So this is not a secret that the biggest contracts and deals, at least for now in the Oracle category, comes from the integrations of the new networks. So if that category is the most prone to create viable contract, naturally, number of networks can be a good indicator, like how an Oracle is performing and the capacity to go to new chains. So for example, Chainlink, to my knowledge, is on only 2 non-EVM chains. I think it's Aptos and one more. I don't remember right now. Whereas RedStone is already on Ton, Move, Sui, Solana, and plenty of other ecosystems.
And I guess, could you walk us through how you plan to perhaps capture additional market share? Sounds like Chainlink is, based on aggregate value secured. Chainlink is in the lead. Forget the number you just spit out for Pyth, but also have decent traction. How do you plan to capture market share from those two?
Well, as we do right now, I believe we are winning a decent number of deals as we go. And usually it's because of the speed of delivery. So everyone in crypto has short timelines. And this is where having engineering capacity helps a lot, because then we can offer priority or very efficient go-to-market in that sense. Second is customizability, as I mentioned. So whenever a client requires something that is not necessarily off the shelf, but something more peculiar, then RedStone is a good player because we have engineering capacity to deliver so. And I would say the third factor is also pricing the integrations more reasonably. There was a period when Chainlink in 2021 or 2022 was perceived as a sort of monopoly. And over then they were putting enormous margins sometimes with clients, or at least trying to. Right now, it's not that time anymore. And naturally, with our way more reasonable cost structure, we can go lower on the price, still keeping a very healthy margin on every integration. Whereas them having high cost structure, they just have to hit for the highest ticket players or just forgo deals.
Can we double click on that? What is a typical price for an integration of an Oracle? Like how much does a contract make?
It depends on the complexity, naturally, because as I mentioned, depending whether it's on the shelf or not, but an EVM, Ethereum Virtual Machine compatible network integration can be anything between $100,000 to $400,000 a year, depending on how many price feeds they are, the time to market, so the delivery period, and also some other peculiar either technical challenges or requests for the protocols that are over there. For the asset issuer, yearly contract value would be at around $60,000 a year, roughly, depending again on how hard it is to deliver and then how many networks are included. And for the dApps, it's very much dependent on here it's very hard to quote the number. That's also the reason we delivered this Atom solution where effectively the dApp doesn't have to pay anything. They just have to accept to use the product. And then we even pay them part of the money that we recapture back, and we capture a portion of it. For Atom, for 2025, I believe the revenue should be at around $100,000 because we launched it fairly recently. But this value can scale very quickly next year as we will be going towards $1 billion protocols. So for example, Venus, Compound on the major networks and so on.
So just like very general for the first two categories, is it just fair to say like number of customers times like, on average 75,000 a year? And like as more customers come in, oh, I'm sorry. No, you said 100 to 500. So like, some weighted average between those two times the customers is kind of like how to think about the top line.
Right now, I would say give or take, yeah.
Maybe we talk about the token a bit more, but perhaps on the supply side. So when did you launch your token?
That was in 6th of March, 2025.
Great. So fairly new. Can you walk us through some of the supply side dynamics? How much is currently circulating? What is the, forward-looking projection for unlocks, and what type of, issuance profile is there on the supply side?
Yeah, happy to go through that. So on our blog, there's a post introducing Red Tokenomics, and all the details are put in the table. So the max supply is $1 billion, and the floated TG was at 28%. All the unlocks are in the token unlock schedule for 4 years from the TG. The current float, I don't even know. I would have to check on CoinGecko or CoinMarketCap. Yes, it's still at 28%. So the unlocks have not hit yet. Oh, yes, that's because it's 1 year from the TG date.
Like, just again, back to the token, right? And the value of the thesis of the token, right? Like, what role does it play? And like, why should I buy the token itself to capture the value of the Oracle business?
Yeah, that's a fair question. As mentioned, if you buy a RedStone token right now, there's an opportunity to stake it and earn rewards for basically securing the network from the data provider's side. And as we scale the operations of RedStone and grow the revenue, there is the plan to stream parts of the revenues for the stakers themselves, right? So if you believe that RedStone will be growing its go-to-market and essentially taking market from Chainlink and capturing the new market in the Oracle category, because again, I would like to emphasize that the data category is like a big one, ever growing, and there are not that many serious players. Like whenever I hop on a BD/sales call, I'm going to be asked only about RedStone, Chainlink, and Pyth. Like those are the three players that the general market accepts. Naturally, there can be a flavor of some other players because of the historical relationship or whatsoever. But if you're going to ask an average person with no previous connection to any of those oracles, those are the top three that everyone is considering, whether not launching a new chain or a new token and so on.
How does the staking, this is something actually I want to touch on earlier in the product side, because obviously security is a feature probably you talk to clients about, right? Because you have some nodes or some operators, or maybe you're those people who provide the data set. How does like the red staking, EigenLayer restaking, how does that all fit in with the network and the data delivery?
That's a good question. So data providers stake RedStone token in order to gather their rewards. And whenever they deliver the price feeds, if what they deliver is inaccurate, they are subject to slashing. And the stakers on EigenLayer can delegate to specific operators. If you go to EigenLayer RedStone AVS, you can select which one you would like to support, which one you believe in, and then based on that, gather the incentives from that particular one.
And so if you're staking Red, you're getting Red emissions. Is that right? Primarily?
Yes.
If EigenLayer restakers do you have ETH restaked on it, or are you just using EigenLayer as the infrastructure for the Red staking?
Just for the Red staking.
Can you walk us through how those economic incentives? It sounds like there's a slashing mechanism that is instantiated for data providers that go awry. Can you walk us through how that works? How do the checks within the system actually function?
Yes, the slashing is being implemented as we speak, but most importantly, RedStone is the only main oracle that has never ever had a single mispricing or downtime event. And as I mentioned before, reliability is one of the core features in general in blockchains. And here I can bring you up a situation that happened literally a couple of days ago as we record. So Chainlink did experience a mispricing event for an asset on Base, which is wrapped restaked ETH. And Moonwell, one of the flagship protocols on Base, accrued $3 million of bad debt. And that was a second instance of a similar mispricing. 30 days ago, roughly, Chainlink had a mispricing and they accrued $2 million of bad debt. So it just shows that altogether, $5 million of bad debt was accrued because of those mispricings. And we are not talking here about 10%. We are talking about over here about, I believe, 6 orders of magnitude. So instead of valuing one wrap staked ETH to, which erroneously reported that one wrap staked ETH equals to its 1.7 million ETH. So approximately $0.8 billion. So it shows that this mispricing was like by an order of magnitudes. And one of the reasons was the balancer hack. So on this low liquidity price feeds, Chainlink did not interact quickly enough to warn the users like, hey, on that particular pool, there might be some problems, right? And this is how Moonwell got hit, to the extent that Luke, who is the founder of Moonwell, did provide like a video of 11 minutes talking about the whole incident and how they lost trust in the reliability of Chainlink price feed for that market and in general. So this is like a good example of why oracles matter at the larger DeFi scale.
Marcin, can you walk us through how, on the topic of staking, how does system security work? So presumably folks, stake the Red token and they follow the network rules and provide good data. And if they don't provide good data, then they're slashed. Can you walk us through how that works, if it's live and if it's, maybe it's on the roadmap?
Yeah, of course. So the whole staking mechanism is live and people can stake Red tokens as we speak and accrue the yield in the Red rewards and Eigen. The data providers deliver the price feeds and the data to the nodes. So this is live as well with the stake, though the slashing mechanism is still being rolled out as we speak. So it's under development. But here, one important aspect I want to point out is RedStone is the only oracle that has never ever had a single price manipulation or downtime event. So even though the slashing is not implemented, even if it had been, it wouldn't have been used because there was never like such a situation that required a slash.
How does the governance work for RedStone?
Oh, that's a good question. It works similarly to Chainlink. So there is no DAO in RedStone. There is RedStone Distributed Data Association that is the issuer of the token that takes decision like how to expand the ecosystem of RedStone.
So no DAO. There's obviously the than just the token. And then, but you have, is the association different from the, I guess it's probably a labs entity, or is that just you guys, the same one and the same? Is there a foundation?
Yeah, the association would be similar to the traditional foundation model, but it's a Swiss entity. And there's also a labs entity that is working on the development of the tooling and the infrastructure.
And then if there was to be, say, I guess, how could revenue get turned on in the future? Do token holders, they don't have necessarily a vote in that. Is it, that the labs or the foundation turns it on? Or how would that work in the future?
Yes, that would be a decision of the association. So let's call it foundation. And that part, that at a certain point, the revenue or maybe even profit is significant enough to include that in the whole flow of the token value.
As a red token holder, why would I believe that the foundation is incentivized to turn that on and when would that make sense for them?
Well, foundation works for association. Association's goal is to expand the ecosystem and make sure the number of users is ever growing and is more diverse, but also that the red token is widely adopted and people believe in it. So naturally, at a certain point, if revenue keeps growing and the ecosystem would expect that this is a good moment to turn on the revenue feature, that can be implemented. So it's more of a discretion of the association to decide, and it's going to be driven by the market condition and how well the penetration of RedStone works. And I believe it's similar as many other crypto projects in that category.
Yeah, that's fair.
Yeah, I think that makes sense. So maybe looking forward, what should investors be focused on as potential catalysts or upgrades?
Yeah, I believe this adoption in both the DeFi markets, but also the institutional players. Recently, RedStone acquired Credora, creating a unified DeFi rating system. As we record that podcast, recently we've witnessed a collapse of Stream Finance, XUSD, which was a pretty painful experience for the DeFi ecosystem. Credora is a good, not ultimate solution, but part of the remedy for that kind of situations, because what Credora does is rating a particular DeFi strategy. So you can imagine SUSDE looping on Morpho on Ethereum against USDC. So this whole strategy is being assessed by Credora engine and then given a rating between D to A, so that both the retail and institutional allocators can use that in their decision, like where to put money. Because as we speak before Credora, right now, yield is the only metric they look at. If one thing is 8% and the other thing is 12, naturally you should explore 12. But then if you learn that the 8% is A grade and 12% is C grade, then naturally your decision might be influenced differently. So Credora is now part of RedStone. We relaunched that on 6th of November on Morpho and Spark. And the pipeline for new integrations is full until the end of the year because the market feels the need for those risk ratings. The reason it's relevant for RedStone is for risk rating to be created, you need data. And this is something that RedStone gathers and offers. And also it's an adjacent product that we can offer to the clients that I described before. So here the clients are the lending protocols that pay, again, for integration and maintenance. So it's a similar model. And vault operators to increase attractiveness for the products that they offer in the platform. Eventually, we also want to introduce a model where we can take a percentage of the management fee if we help the specific vault to grow, to make it a bit more scalable. But we are at early days of rolling out Credora, so we are going to see how it's going to roll. Second catalyst for RedStone is going to be launch of a historical data product. And here where it gets interesting. How many historical data products that are affordable you guys know? Can you name any?
I'm going to guess there's 0.
David?
I've learned not to bet against Sean. I'll go with 0.
Okay, to our research, there are 2 that are reasonable, and both of them are okay. They are operating, but have problems that we've learned from our clients. And where majority of people in the data category chase speed to ensure like the highest frequency of the updates, the hard truth is if someone truly cares about speed, he or she is going to build the pipeline by him or herself. So it's not going to use a third-party data provider, because any additional hop on the data delivery road is going to introduce latency. So we started to explore, okay, if we are going to offer high fidelity and granularity of the data from 2019 until today, including centralized exchanges, decentralized exchanges, and many other information that we are going to offer to the users, the quants and market makers and prop shops that are interested in trading crypto can find that data very lucrative for trading their algorithms and taking out insights from the history to fine-tune their future strategies. So it's a product that we are launching roughly in December, January, and it's going to be targeted mainly for the Web2 users, because I talk with institutions absolutely weekly, and many of them think, okay, where should I start? And we are going to come to them, hey, here's the historical data, so you can analyze various types of products that you can introduce based on that historical data. So I'm pretty excited about that one.
So I want to move to risks, and I want to actually ask the question in 2 parts. The first part I'll ask will be kind of a bigger picture risks related to kind of some DeFi stuff going on in the market. And then the second section I'll ask about, RedStone specific. So on the first part, and I think this is kind of timely, obviously, given the 10/10 flash crash, and you guys have a lot of insight into how DeFi is performing right now. I've had some other folks, and I'm not verified this myself, but have told me that there's trouble with the curators, the on-chain liquidity, some of these vaults, and some of the redemptions and stuff like that from that. I mean, have you seen anything like that, or any, under the hood issues with the vaults or anything like that in DeFi following kind of the correction? Is there any broader risks to the market there, or what are the risks there?
Yeah, that's a broad and good question. On 10/10, many people got wiped out, and some of them are not so proud to share it, right? So we are seeing defaults, Stream Finance being one that is very much public right now. I believe in general, the curator model is good. It makes a lot of sense because Morpho, Euler, and those modular lending and DeFi protocols are offering a toolbox. And that allows true professionalists to come in and use that toolbox in the best possible way. Though in the early stage, as it is, in my opinion, right now, we are going to have operators that will be taking riskier and riskier bets in order to gather more and more TVL in a short time. So they are incentivized to offer, again, the highest yield because there is no risk metric on Morpho on those kind of protocols. So users look only at the yield. That's where Credora comes in very timely, giving this second vertical. But I would say the vault operating business is going to bloom and expand. Even Aave v4 that is being introduced, it has this hub and spoke model, and spokes are sort of like operators, like vault curators in a sense. So it shows that more freedom in that model is just needed. And I can imagine in the next maybe 12, maybe 24 months, true big players from TradFi coming in onto on-chain with their brand, with their knowledge, with their skills, and operating on those kind of Morpho or other protocols. Because if they wanted to go to Aave v3 as it is right now, they have little to do over there. Like Aave is governing everything. Whereas in Morpho, it's way more open.
Just one follow-up. So do you think there's going to be a liquidity crunch? There could be a liquidity crunch in the vaults. Like, you saw last cycle, obviously there's a lot of deleveraging that happened with Aave and, the lending protocols. Could there be some type of DeFi related event in these curator vaults?
Yes. And I think the default of Stream Finance is the best example where many of the curators hard coded the value of XUSD, which was this receipt token from Stream Finance, to $1. So they I don't remember what was the base value. I think it was $1, but they hard coded it. They didn't follow any sort of either market values, how people trade that token, or even proof of reserve. So what should be the value given the reserves that are available on the protocol for redemptions. So those kind of actions are going to introduce systematic risk if things go south, that we can see defaults and bad debt accrual basically into the protocols. But I believe it's over and over the same in finance. People have the period of really good yield and really good growth, then get overconfident and are taking too risky bets. And then at one point it has to hit and we go over and over again.
Now to RedStone, at a high level, are there any risks for the token investors should be aware of?
Well, I don't believe there are any risks related to the token itself specifically, because the model is fairly transparent and obvious. I would say as we go forward, we will be fully focused on the growth and expansion of the new products.
And I guess, that is, let's go to the closing thoughts here. To wrap it up, are there any last takeaways you want listeners to have, or just, from this conversation?
I believe there are three. The first one is that we are heading towards the end of 2025, and it's been a very interesting year. As RedStone, we were an oracle that supported the launch from day one to Berachain story protocol. So big hype launches from Q1 that some people might not remember that well anymore, but are still very much present, and we keep supporting them. We learned throughout the year that we need products that have exposure to institutions. That's the reason we acquired Credora, because there is also an opportunity to offer ratings for tokenized assets and other types of products that are related to institutions, but also are launching this historical data product at large. And last but not least is that we are having a couple of bets in 2026 that look very promising. Recently, we launched Hyperstone, which is our version of an oracle that is dedicated to HIP-3, which is the permissionless market creation on Hyperliquid. So anyone who has enough hype staked can create a market choosing 2 assets and an oracle. And Hyperstone is a dedicated bespoke product that targets those kind of HIP-3 markets. And over there, the revenue generation model is based on the percentage of the fees that the creator is introducing. So it is a very scalable model looking at the revenue that Hyperliquid is creating right now. Second area are prediction markets. We recently announced that RedStone delivers data from Kalshi on-chain when it comes to the resolution of the markets, odds, and many other types of information that lives in Web 2, because Kalshi is primarily Web 2 protocol. But going forward, we know there are some talks about tokenizing, for example, big prediction markets positions. So you can imagine that the prediction market for who is going to be the next president of the United States is going to be a huge one, and a market that is going to last for a fairly long time. So people who have allocation in a specific side of the position can tokenize that position and using DeFi again as collateral or for any other reason. And this is where an oracle again is going to come in place. And prediction markets are especially interesting because the risks and revenue, the direction towards which market is going is many times uncorrelated with the traditional finance ecosystem. And last but not least, we want to support institutional players to introduce the DeFi products into their web apps and front ends. So I can imagine on Revolut, Robinhood, Stripe, those big financial giants that are already experimenting with crypto, they're going to be abstracted away just buttons that you can invest, for example, on a looping strategy on Morpho. And this is where Credora, again, is going to come in handy, because we could, for example, offer a product for them that is going to have even higher bar of verification, and only A++ products can be offered to those kind of clients.
It's a very informative conversation. Really appreciate you taking the time to run us through your business and the token. And hope we can do this again sometime soon, down the road. But thank you for joining us, and that's a wrap.
That's a wrap for this episode of Level Up, where liquid token protocols meet the sharpest minds in institutional investing.
If you found value in today's conversation, don't forget to subscribe and share it with your network.
For more deep dives into blockchain's most compelling projects, reach out to us or follow the Medici Network for more insights. Until next time, keep leveling up.